I'm Rebecca Riley St. Thomas, and I'm here with my son, John St. Thomas, and we're proud to be sales managers and senior mortgage bankers here at CMG Financial Home Loans. And we are so excited today to have Dave Herbst with us, and he is the vice president of the All-in-One Loan. He was recently named as a 2022 Housing Wire Insider. Dave was recognized for his incomparable contributions to the growth of the All-in-One Loan, his dedication to educating industry professionals and borrowers, real estate agents and fiduciaries on impacting the mortgage product and the need for this type of innovation. And as John and I have recently joined CMG Financial Home Loans, Dave's YouTube videos and our further research of the product was one of our deciding factors in choosing CMG Financial. And Dave, you have been so kind to travel here to Scottsdale to do two incredible presentations for us. It has been opening, so many doors and helping us grow our businesses. And so we are so grateful for your time today. So thank you so much for being with us.
Yeah, thank you.
Oh, thank you for allowing me to participate. And it wasn't a hard jaunt from where I live in San Diego out to Arizona, out to Phoenix and Scottsdale to join you guys. And that was a fun trip. And I hope to be able to join you for many more in the coming months. And I'm super appreciative of the effort you're putting forth to raise awareness on the product. It's a powerful tool, as you know, and I appreciate the fact that you guys are doing this.
No, absolutely.
Well, we kind of want to start on the history and the purpose of the creation of this product a little bit, and just, why it came about, how you decided to create it, and just where it all stemmed from.
The concept of the all-in-one loan, and for everybody that's viewing, just very briefly, the product structure is unique in that it merges together a mortgage with personal banking into one very flexible, fluid account that really helps borrowers, whether that's a home buyer or a current homeowner with a mortgage that refinances into the all-in-one loan. It really helps people have an easier time gaining control of their payoff trajectory, certainly having much greater influence over their total cost on the loan. Because it leverages everyday normal cash flow that would normally flow through a regular checking account in order to essentially shrink the size and the cost of the mortgage faster, and then do it safely while keeping money liquid, right, for use, for bill payment and everything else. So it's the term all-in-one loan or all-in-one loan mortgage or all-in-one accounts is really sort of synonymous with our product. And the idea behind these types of products is not new. It seems newer here in the U.S., but it's globally, they're really not. These types of products have existed for decades and decades in other countries, predominantly throughout Western Europe. They're known as offset loans or offset mortgages, but also in Canada, Australia, New Zealand, India, and also here in the United States in the commercial banking space. There are accounts called universal accounts or money merge accounts that are used that are very similar. And again, it's just consolidating, into one tool, bundling together, cash flow management with debt, right, into one financial product that helps minimize the amount of interest that you have to pay on that debt by using money you already have. So it's a really simple concept, but not a new one. The way that we came into understanding it and that built our excitement and motivation to build it out really began back in 2002, where the founder of CMG Home Loans, Christopher Matthew George, was actually speaking at a banking conference in Australia. One of the reasons why the lending landscape in Australia was embracing this new way to lend and help people pay for real estate was because the government of Australia around that same time had eliminated any tax deductibility benefit for paying mortgage interest, right? And that really kind of sparked or ignited the innovation or the need to innovate the mortgage and the way they were financing real estate. Of course, we get to enjoy that still today, right? We still obviously have a tax benefit for paying mortgage interest, but it's still not a reason to pay more interest than you have to, right?
Right.
But down there, the innovation began to unfold, and Chris happened to be there around that same time. And just began to familiarize himself with it and thought it was brilliant and that this is kind of one of the missing, components of lending. And Chris was pretty motivated to do that because, as you guys know, him, he's a he's just a pioneer by nature, an
Absolutely.
innovator by nature. Yeah. And as a family owned and operated organization, one of the largest in the United States, I think it's just part of our DNA to try to press forward and identify better ways to do what we're doing. And there's been a lack of innovation really in the industry for a very long time. And I'm not talking about the type of innovation that feeds the bottom line, the profitability of a bank or lender. I'm really talking about the type of innovation that puts the consumer up front, right, out front, and puts them in a better position. Because if you do that, if you can achieve that, well, you create stickier relationships, longer lasting relationships. I think more rewarding relationships by helping people, right, and putting them first. And that's what this mortgage product does. And so we set forth in developing our own version of it, and we put it to market in 2005, June of 2005. So we've had this available for 17 and a half years as we sit here today at the closeout of 2022. And it's been an awesome journey. But it's different. And so it takes some education, which is why potentially a lot of people haven't heard about it yet. But it's certainly not a new product or not a new concept.
Right. No, absolutely. Absolutely. Well, and, in talking about the bank account, talk to us about, the power of the deposits, because some of the things that we're experiencing with people that is amazing is that this is really a mind shift change, like how we can use our own money to benefit ourselves instead of the banks. And no disrespect to the banks, right? But with this product, you really can show how you can use your own money to help yourself. So talk to us about that if you could, please.
Yeah, that's right. It's it does require a little bit of change in your thinking. It almost forces it, right? The way we think about money, everyday money, and our mortgages. I think on one side of that, when we think about mortgage debt and the way we manage and finance real estate, we all kind of gravitate to what we know, the commodity products that the industry has been offering, and we do it very well. Talking about the 30-year fixed, the 15-year fixed mortgage, the standard ARM products, and they serve a purpose, and they always have, since inception, since the 1930s. Certainly, they are suitable for the right people during certain periods of their lives where they need that payment, dependability, and and there's not too much education that really is required to understand how a mortgage works. You just have to make your payment. But at the same time, there's kind of, I think that people generally enter into busier portions or segments of their life, right? Without question, you kind of begin to grow into greater responsibility. You take on more debt. You really can't build a decent standard of living any longer in the United States without having to take on debt. Most Americans have more debt than just their mortgage that they have to go through and pay for. So as people get busier and busier, they also sort of demand, I think, a lot more flexibility, a lot more kind of control, and also liquidity. A lot of people need access to additional resources without having to tap into their maybe retirement savings or, their rainy day money. And that's why the all-in-one loan is really powerful. It's really, I like to kind of repeat, it's not just for first-time home buyers. It certainly can be used for the first-time home buyers, but it's certainly, I think, intended for the busy person, the person that just needs more flexibility, more control. And I think the one thing that a lot of people on the other side of the all-in-one loan, which is the checking account that's linked with it or embedded into it, I think when you think about checking accounts, which I don't think a lot of Americans, by the way, think too deeply about their checking account. We're more prone to get a divorce than we are to actually change our banking, and so. But if you really kind of sit back and think about the volume of money that passes through just your regular checking account, your standard everyday, traditional checking account. Most of us use one. I don't think anybody could qualify for a mortgage without, knowing how to use one or having one in place. The volume of money that passes through a standard checking account for any one American over just the course of 5 years is likely more than that person owes on their home loan or will owe on their home loan. So people earn the resources necessary to get rid of their debt faster. The issue really lies in the fact that account is kept separate, right? So our earnings, our income is really managed through separate financial facilities than our debts, right? So on one hand, we have high volume of money that passes through these accounts that really don't provide us, much in return. We're not earning much interest at all on our checking accounts or savings accounts relative to what we have to pay out on our debts. We'll always pay more interest, higher interest rates, and higher volumes of interest dollars on our debts than we earn on our income. right? As we manage those through, cash accounts. This is where the brilliance of the product, comes in. It says, hold on a minute, let's not let cash land and sit idle, doing nothing or earning little, if anything at all. Let's let the mortgage be that landing place, because the mortgage is costing much higher interest. Let's allow that cash to just reside in the mortgage automatically for the customer, which automatically then creates the benefit of reducing the amount of interest they have to pay each month. It's just a simple change, but it certainly sort of illuminates the power of your income. And that I think is kind of the underlying story with a loan that's super powerful is like people have the resources, they earn the resources necessary to get out of debt sooner than they think. They just don't have the right financial product, right? It's all about the products and services we develop for them. And that develops the behavior that creates the incentives and the benefits. And that's what this does.
I love that, because whenever I talk to borrowers and people, I'll say to them, like, why do you have a checking account? Like, why do you have a savings account? And they kind of look at me like, that's a dumb question. But I'm like, well, no, really, like, why do you have a checking account? And they're like, well, because I need to put my money somewhere and it provides liquidity, right? And like, if I need that money tomorrow, I can get it tomorrow. And so I'll say to them, I'm like, well, it's not to make money, right? Like, this is not a financial instrument that you're using to earn interest or make any money. And they say no, right? And so I'll say to them, like, all right, well, what if you could take that same type of instrument, remain fully liquid and have all that liquidity, but now it actually is going to provide a savings of X% and benefit you in a way that the checking account never benefited you before.
Yeah,
that's right.
Kind of, how does that work? How can you do that? That sounds like too good to be true. Mm-hmm. Like, I promise it's not. But yeah, for a lot of people, it's just so foreign. I mean, they, like you said, they just have a checking account because mom had a checking account. And we all need it. I would argue that we all need a checking account, but they never really think about what's going on there. But it's really, to park your money somewhere, even for a small period of time, and to remain liquid, right? So to be able to keep all those features, but actually now gain a benefit from it.
That's right. That's right. And to dovetail on that, Johnny, it's I think additionally, a lot of people don't think about the amount of time their dollars remain idle in their account. I truly do. I think through my experience of, promoting the loan, educating people, getting out there in the marketplace nationally and speaking to people, from financial advisors, fiduciaries, holistic planners, to tax planners, to, home buyers and current homeowners, real estate agents, of course, and of course, industry professionals in mortgage. I can tell you that through that experience, one of the things that has really become apparent is that people don't really think that much about the length of time that their money resides in a checking account. That's called float. Yeah. And this is what makes, deposit accounts so powerful for deposit institutions that offer checking accounts, where essentially the way to really think about it is we are lending our money. We need the account in order to securely deploy our income to pay for life, right? Life's bills and expenses. But the trade-off is that we're essentially lending our income to a bank, and we're lending it to them at near 0%. So it's a pretty darn good loan we're providing, right, as individual Americans, and with a lot of money. And but for the average consumer, I really do think that most people just kind of walk around, and the day they get paid, whether that be a commission check or just regular monthly wage, or even, self-employed income. I think that a lot of people on just a really deep personal level don't feel like they have a lot of money on hand. When you earn money, it's all spent. It's already spoken for. You got bills and expenses to pay out. So this kind of forces people, or sort of illuminates the reality, is that, hold on a minute, you earn a lot over time, much more than your mortgage is costing you and that you owe. And that money isn't, I know it doesn't come into your account all at once, but it also isn't spent out at once either. Money floats around for days, sometimes weeks, even sometimes months before it's spent on whatever need we have. Right. And so that's where the power of cash flow through an all-in-one loan mortgage works. And that's why it's so powerful. Every single day, John, to your point, every single day that money is kept in the mortgage, in the all-in-one loan, you're effectively saving interest on the mortgage debt, right, on the principal balance at the rate of the loan itself, which means your trade-off, your savings, your benefit is greater than what you could earn with those dollars through a normal deposit account.
Yeah. I say to borrowers all the time, I'm like, do you want to earn at 0.001% in your checking account? You get at the end of the year, hey, I made 14 cents, you're feeling really good about it. Or
Right.
do you want to be saving at a rate of $300 or $400, whatever the number is, a month. And then, hey, now look, at the end of this year, I just saved, $4,000.
In a compounded fashion, right? So if month one, you're saving $200 in interest in the all-in-one loan. Well, if you kept that $200 of savings in the all-in-one loan moving into month number two, right? That now means that your principal balance is starting out during month two at a lower starting point than where it did the previous month. So now that $200 in savings turns into potentially $350 or $400 of savings during month number two without any change in their budget, without any change in their lifestyle, no disruption whatsoever. It's just money being utilized more efficiently.
Oh, yeah.
Absolutely. And I think that was so powerful too, is that when we show this to people and they understand it, they think, oh my gosh, it actually encourages them and they get excited to save more money because they're like, oh my gosh, let's put more money in there because it's going to drive down my principal balance, therefore reducing my interest only payment I make, increasing my equity. And this is magical. And then people go, oh my gosh, I'm responsible fiscally anyway. Like, let me be even more. And it's kind of like a game. They look at it and they go,
totally.
Gosh, look what this is doing for me. And it's an amazing life-changing product for people.
Yeah. So one of the, clearly, and I think we're going to probably, it's a perfect segue probably into where you're headed next, which is the simulator and talking about forecasting benefit. Just to add to what you were saying, one of the things that we want to develop out pretty soon is a real-time informational app that provides notifications to account users, to our customers, that provides them, you go, imagine this, you swipe your all-in-one loan ATM debit Visa card at the gas pump, you fill your gas tank up, you spend $100. That of course comes out of your mortgage. Your balance increases by that $100, but it's still lower that day, right? Because the bulk of your cash is sitting in the account waiting to be spent on other things or not spent at all, right? It's just there in creating savings. But imagine on your phone, you get a little notification that lets you know how that just impacted your trajectory for payoff and interest savings relative to a goal that you may have inputted into the app. And conversely, payday comes and it tells you, hey, you've just shed off another 2.5 months off your mortgage time, and just because you got paid today. So that the building the incentive, and I think the engagement, the visibility is important. And I think honestly, that's what's lacking in the financial industries, certainly mortgage. A lot of people they feel like asteroids. They're just kind of floating through space, not sure where you're going to land one day. It's hard to know. And I think having some understanding of your trajectory is really important for people.
Oh yeah. Well, it makes it easier to make better decisions when you have that awareness, right? It's almost like the joke when you go to a restaurant, it says what the calories are on what you're going to order, right?
Totally.
You take a second guess about whether or not you're going to order that thing, right? And you're like, maybe I won't get the pasta. Maybe I'll get the salad because I'm aware of it. Right. Same type of concept where you see how that, payment at the pump now affected you, or that income just affected you. And you're like, wow, when I do make positive decisions, I do see benefits happen. Right.
Yeah. Yeah. That well said. If we weren't recording this video, I would steal that from you, John, and claim it as my own.
Yeah.
Now I can't do that, but perfect. That's a great analogy. Did you want to? Yeah. All right. I will. So the simulator, you want to talk about the simulator?
Yeah. Absolutely. We love it. Yes.
Obviously, this is all theory without being able to provide evidence of how income dollars applied to daily loan principal can actually, save people money and time, right, and create equity in a home sooner and provide them opportunity. I think the optionality is one of the biggest advantages of the loan. How would you like the option to save a bunch of money and time, even if that didn't make sense for you right now? Would you like the option to be able to maneuver through life without having to go chase interest rates around or loans, go apply for additional loans? Well, being able to forecast the benefit, the potential savings is important to us. As you know, it's required. It's a required step to generate what we call a simulation. And we do that through our online calculator. Of course, we have an online interactive, publicly available interactive simulator that measures really everything you'd need to know. Simple inputs, takes about 2 minutes to get through, and then provides a bunch of features where it'll help a user of the calculator stress test, different climates, different economic cycles, different rate environments, changes to their budget, maybe, certain things they want to achieve in the future, like maybe buying another investment property or moving, what would that look like? But it measures payoff timing, total interest cost, and it compares it to a traditional loan.
Right.
And so it's required. We want to make sure that this is being put in place for people that know how to manage it and are suitable for it. But it's also going to help them save tremendous amounts of money and time. And I'm not talking about a little bit. You guys know, you've seen the results as you guys are originating these and promoting it. It doesn't save you a little; it saves you a lot. It's life-changing. It's meaningful.
Right. It absolutely is. And to your point about it being required, as John and I started here and talking with people, we've told them this is a required video meeting, just kind of like we're having today, right? Or we sit with someone in person. And so we require going over it. It could be a 45-minute to an hour and a half consultation that we have with people. But like, for instance, you talk about the power of this program. We're working currently with an investor that we're closing on a loan this week. And when we showed him the power of this product, the loan is going to be paid off in 8 years. He's going to save $537,000 of interest over time. And his effective interest rate, we know this is not the interest rate, but the effective interest rate as shown by the simulator is 3.8%. So where in today's market are you going to pay off a loan in 8 years, but get an effective interest rate of 3.8%? And, it's just amazing. So, to your point, this is, and the other thing is, because it's available to the public, one of the things that we do in all of our email correspondence with wrapping up our initial conversation is we take your videos along with the simulator and some, frequently asked questions. And we will email it out to the borrowers and say, here, this is what we sent to you after our initial conversation. Let's go on and play with it and everything. And like, as an example, with this particular investor, he's very savvy and he was all excited about it. And so he kept calling me throughout the process, over the last few weeks. And he says, Rebecca, I just thought about this. I'm going to be getting this money from, this investment that's going to be coming due. And you know what? I'm going to put it in there. And you know what? I just put it in the simulator. And this is what it told me that this was going to help me with. And this is just amazing. So it's like, it's so rewarding, especially at this time in our market, to have someone call and go, I'm so excited. This is the greatest thing, because people don't call you and tell you that, and we learned this from our wonderful Adam Pugmire, people don't call you and say, oh, thanks for the 30-year fix. That was just wonderful, right? But people call you and they say, hey, this is great and it's life-changing. So, just being newly here to have this excitement with our clients is wonderful.
Yeah. I mean, I don't think the words love and mortgage tend to belong in the same sentence. But exactly. that's exactly the feedback we get, routinely, and we have been. So it's powerful.
Yeah, I was going to say that exactly. Traditionally, I don't think somebody gets like excited for, the idea of getting a mortgage, right? But this is a different conversation where we actually have clients who are calling us like, I can't believe I can do this. Did you know that I could do that? Like, what if I applied my money this way? How does this work? And those are never calls that I'm getting on a 30-year fixed loan. Nobody's like, man, what if I did it like this?
It just goes further, right? I mean, so here's, something just to add to that. Most Americans, as we know, need financing, need to borrow money in order to buy real estate and own real estate, right? Probably life's most valuable asset is the home you buy, and real estate in general, American real estate specifically. And we know about 8 out of 10 Americans in the market to buy, even recently, still need financing, right? So obviously that makes sense. Fewer cash buyers, right, than those of us that need a loan in order to make it work. So the lending industry and what we do for a living and what we do to serve people is extremely important. Of course, it wouldn't work without access to credit and good people like you guys to be able to provide that service. But I also think, clearly we're sort of subject to the products and services that we have, right? We behave accordingly. And when I think one of the powerful things about this loan is that you stop thinking about it as a loan. You really start thinking about it more as a financial security blanket, a way to better manage, debt and your life in general. And it sort of illuminates what's possible. Right now, it sort of opens or awakens your mind to things you can accomplish securely, and when it makes sense. I think that's also one of the things, because it's flexible. It's a 30-year draw line of credit, the only one in America. that applies to anything you put towards it through the deposit directly to loan principal, the only one in America. It's also the only mortgage product that recomputes interest on that new principal balance nightly, right? The only one in America. So to serve the customer and helping them reduce what they owe and the cost of that money is a powerful mechanism. And that's what cultivates or develops all these different options for people. But it's that choice. Sometimes it doesn't make sense to remodel the kitchen. Maybe you thought it would right now, but now you go, hold on a minute. Things kind of look uncertain out there in the economy. Maybe a recession's coming, maybe it's not. Why don't we wait another couple months? Right. In the regular mortgage landscape, you're making a decision and you're locked into that, right? Cash out refinance in order to get the money out of your home to maybe renovate or something. You're already in, you're committed. Well, with the all-in-one loan, you have it available, but you don't have to pull the trigger. You get to decide when that makes sense, when it doesn't make sense, and flexibly maneuver through time. And that optionality, I think, is a huge advantage, especially for today's homeowner and home buyer.
Yeah.
No, absolutely.
Yeah.
Absolutely. And I want to talk about a couple other things. Will you touch on how, if you're a fiduciary, financial advisor, tax preparer, like how does this help you with your client base and your business?
Sure. Well, again, most people, another quick stat, right? Most people need to borrow in order to own real estate. And, I think when you think about the mortgage and debt in general, you borrowed money. So there's interest cost on that borrowed money. The longer you take to pay back that money, the more it's going to cost you, right? The higher the expenses on that borrowed cash. So one of the strategies that I think really fits well in with any fiduciary, any financial advisor that is interested in not just building, on the wealth side of the balance sheet, the asset side of the balance sheet, but an effective way to have more money available to build wealth and financial security, and not just wealth and assets and investing, but also, the insurance products, proper tax planning to reduce your liability so that you have more left over and available when you retire. A good strategy or a great strategy to actually develop more of that is by reducing unnecessary expense in your life. And, clearly the mortgage, statistically, it consumes the most amount of income out of any other debt that we commit to. Right. Consumes about 45% of all the money at the household level that's spent servicing debt, paying for debts. So clearly it's an obvious place to farm savings from. The problem is that, traditional loans tend to be, kind of slow, rigid, inefficient, and expensive financial products, even with low interest rates. Again, because of the amortization built into a traditional loan, it keeps the loan balance higher for longer, right? In which interest is being computed on. So you end up, even with a low APR, low interest rate, maybe for some of those people that are listening to this and that maybe refinanced or got a mortgage a couple of years ago when interest rates were much more favorable. That's great. I would argue that the interest rate isn't the issue with borrowing money. The length of time, the terms are the length of time, and how the principal is being controlled. Is it being controlled by you, or is it scheduled out in advance, therefore artificially keeping it higher and your cost higher as well? The all-in-one loan, again, reduces the principal balance faster, and in doing so, you customers spend less each month and annually and over time on mortgage interest. That's money that is kept liquid in the product. So customers can then use those savings more appropriately. There's bigger and better things to spend money on, clearly, than mortgage interest, right? Most Americans that are really sort of the pre-retirement segment, people, Gen Xers and baby boomers specifically, are not, by all accounts, not on track to actually retire securely with the amount of money they need to have saved versus what their lifestyle costs today. So, this helps that segment of the population as well, because it accelerates pay down, farm savings. That's savings that could be redeployed by a financial advisor, by a fiduciary who is looking at both sides of the balance sheet, trying to just get somebody to their retirement securely with what they need, and maybe more, maybe even debt-free, taking advantage of reducing liability in a lot of different areas. So it's a tool. It's certainly a financial tool that could be leveraged by a holistic planner to help people get ahead sooner in their life.
Yeah,
absolutely.
Oh, yeah, absolutely. No, it's really nice to be able to talk to a financial planner about this product, because I think most financial planners, they see a mortgage and they see the interest rate associated with that mortgage, like many borrowers do, right? And they say, okay, 4% is better than 5%, 3% is
Right.
better than 4%. And that's it. I mean, that's the extent,
Right.
right? So when they talk to their client and they're like, what's your current rate? It's at 5. And what's the rate today? It's at 4. There's a better deal. Maybe go look at that. But with this product, it's really neat because, it is less rate dependent, depending on one's cash flows and savings and things like that. But it's nice too, because in our industry, depending on one's occupation, referrals tend to go one way. And generally speaking, it goes from financial advisor to mortgage professional. There are some times where we can give the referral back, which is awesome. But, so there's not huge value that we can provide to most financial advisors other than, hey, I have a low rate right now, and
Right.
I'm your friend, so you refer me that deal. It's nice to now have a product where you can go back to a financial advisor and say, your job is to try and help the financial picture of your client. I have a product that can immensely help their financial picture.
That's right.
Furthermore, if they are paying this loan off in, say, 5 years, 8 years, 10 years, as opposed to 30, that of course, enhance their financial picture. But now, because of the fact that this is a liquid, equity line of credit, they could decide to tap, 50,000, 100,000, whatever dollar amount, and give that back to you, Mr. Financial Advisor, so that you can further invest it for them and continue to help. So it also, selfishly for the financial advisor, creates an ability to help, them as well, right? So
Right,
it helps
totally.
the client immensely, but you can help them too. So it's a totally different conversation where I'm sitting down and saying, I'm here to provide you with immense value now.
Right.
100%. And one thing I want to say and kind of remind everybody is that, after all, and I think I said this even in one of our events when I was out there with you guys recently, if you think about it, it's sort of weird how we base our decisions in managing, our mortgage debt, and measure it sort of in this kind of good, bad kind of scenario in our minds, right? And it's all relative. It's all based on interest rates, tends to be, right? Is my interest rate today lower than what the market is providing now? And if not, maybe I should take action. Or if I have a lower rate than current levels, then I'm in a good position. I don't need to do anything. I'm set. I think both those kind of those mindsets are sort of flawed for most Americans, for most borrowers and buyers. Because one thing we forget is that 4% is not the goal. 3% is not the goal. 2% is not the goal. 1%, paying 1% mortgage interest sounds great because it's a lot lower, relatively speaking. But nobody, I think, is happy about paying interest cost on money outstanding. The goal, the end game, is actually zero, right? After all, that's why you get a loan, because there's an end to it at one point, and you hope to get there at one point in your life. And so that means that the end point represents zero mortgage interest. The real question just becomes, now, do you want to delay that process, or do you want to speed that process up? If you could speed it up safely without disrupting your budget, your lifestyle, your own financial situation, wouldn't that simply put you in a better position today and tomorrow? The other thing that people achieve, and that I think financial advisors really love about this, having worked with many hundreds across the United States over the last 17 and a half years, centered on this product, is that the upside of getting rid of, shedding the mortgage debt sooner in your life. What could you do, right? Those dollars now are freed up from mortgage prison. They're no longer held captive. And now they could be deployed sooner, more aggressively towards building wealth. So in other words, your customer that is going to be paid off in 8 years, gosh, what if that, that amount of money that they would have still been committing towards their 30-year fixed, being used to pay down their all-in-one loan balance in 8 years, now suddenly is free. Not to mention more money than that, right? They'll have more residual money, and not counting on them making more income either. It just frees up money they're already earning to now be deployed more aggressively in ways that'll build wealth faster, sooner, financial independence sooner in their life. So there's so many upsides to it, that this product brings to the fiduciary. And obviously that's why a lot of them, gravitate towards it and love it.
No, absolutely. Absolutely. Well, I know we're going to wrap up shortly. I just wanted to touch on, with you, the power of this program for investment properties. John and I and our families are real estate investors. And we have to say that this was probably the thing that we loved the most when we saw what this does for us as investors. And again, talking with you about, the investor client that we're working on currently and everything. We just absolutely love this product, and the benefits to this are so huge in wealth building on the investment property side. So speak to us about that, because we're just so happy about that whole part of it too.
Well, first and foremost, I think it's nearly impossible. There's not another mortgage product that I know that's available in the U.S. For investment properties at this level, right? So we're sort of the standalone lender that has generated a 30-year draw, first lien position, 30-year draw, home equity line of credit with an embedded checking account that helps people better utilize their cash flow to minimize their balance and develop equity in the home sooner, more rapidly. So and make that available for investment properties. I don't think there's another product out there like that. So we do that. We lend on single family residences, multi units, 1 to 4 unit, and up to $1 million for an investment property. We're looking at raising that loan amount as well pretty soon. But I think the besides obtaining the financing somebody needs, I think the two major advantages this product provides real estate investors, having been one myself, is the continued growth of positive cash flow out of the property.
Right,
After all,
right.
Why are you investing, right? You're not just investing for one day to have some cash flow during retirement and have that mortgage paid off. You're also hoping to achieve positive cash flow today, this month, right now, or it hurts, right? It does. It'll hurt. It's very painful when you're not positive, or even you're kind of treading water, you're neutral. So I think creating that positive cash flow is pretty tough. It's challenging with traditional mortgages, given their structure, right? You either have to refinance and lower your mortgage payment in order to create, greater positive cash flow, the difference between your mortgage cost and what you're receiving in rents, or you have to increase what you're receiving in income or lease income off whether that be short-term or long-term lease agreements. You have to increase your cost, right? Those aren't always feasible. Clearly, none of us controls interest rates. You can't really refinance and lower your rate today to achieve a lower mortgage payment. So can't do that. And sometimes you'll price yourself out of the market, maybe even scare away a very trustworthy, loyal tenant, if you increase your rents too much. So it's very hard to achieve otherwise. I think if I was to add a third challenge or need that people have that are real estate investors, it's liquidity. It's just having an easier time, repairing, renovating, improving and buying again, right? Building their portfolio more aggressively, safely. I think these three challenges are all solved by the all-in-one loan without question. You're feeding your rental income, your lease income directly into the mortgage. It serves as your checking account. 100% of that hits principal. You're reducing your exposure to mortgage interest on a monthly basis, ongoingly, not just month one and forever. I'm talking month 1, month 2, month 3. Your monthly payment reduces ongoingly to zero faster than a traditional loan. That automatically develops, positive cash flow, greater positive cash flow out of that property. So it solves that one. And without having to, increase rents when that doesn't make sense, that you can't do that. But it also, given the fact that it's a 30-year draw line of credit, you've got access to liquidity. All that money you're using to power down your principal and save money is liquid still. You pull that back out, replace the carpet, paint, maybe repair something that you need to. Maybe use it for a down payment on another property that you've selected, right? And continue to grow your portfolio out. It's a universal tool that I think is the most powerful financial product that a real estate investor could achieve today.
Absolutely.
Well, yeah, I mean, I think most people, when you invest in real estate, the idea is not to own one home. I mean, obviously that's the first initial step, right? But it's to hopefully get home 2, 3, 4, 5, and 6. And
that's right.
When you're doing that, ideally what you're doing is you're saving money, right? And that can be the cash flow that you're receiving from an investment property on top of whatever money you're saving from your regular income. But once again, going back to our kind of human behavior and stuff we were talking about, where's that money going? It's probably going into a checking account or savings account, and it's just sitting there as float for a period of time, right? Until you build up enough money to go buy another property.
That's right.
We'll park that into this account, And by doing so, it's driving that interest only payment down, which is effectively creating more cash flow. It's going to expedite this process, right? And then you're able to tap that equity, go buy property number 2, and you can take cash flow from property number 1 and property number 2 and flow it into here, and then make that happen quicker and quicker, and then rubber band, use it again and get property number 3, and so on and so forth. So yeah, it creates an ability to make, speed this timeline up potentially.
That's right. Yeah. Most of us have financial goals and needs. Well, most of us don't want to delay those things. We want an easier time accelerating those things. Achieving success sooner is something I think each of us wakes up wondering how we're going to be able to do, but we want to do that. This does that, again, because we're just using money people already have or earning or receiving, and we're using it more efficiently in a place that consumes a tremendous amount of it in cost, right? So one thing I want to add to what John said is that for real estate investors who likely also have a mortgage on their primary residence, right? I think it's a powerful mechanism too to consider putting this on your primary residence or on a primary residence as well. And because even if you have a conventional mortgage on a rental property, if it makes better sense to have a conventional mortgage on that rental property, potentially that cash flow off the rental property could hit the all-in-one loan on that borrower's primary residence, right?
Absolutely.
So we're now using other people's money to reduce your exposure to interest on your primary residence, because technically that mortgage payment on that rental property on a conventional loan isn't due until the 15th of each month, right? So if you're collecting rents and your income's coming in off that property on the 1st, you're now achieving float of somebody else's money to benefit from, and for about 14 days before you need to make that payment on that conventional mortgage. There's a variety of different ways this can be leveraged for the real estate investor.
Oh yeah,
Right,
yeah. I mean, one way that we've seen this too is we work with a short-term rental underwriting company, and they work with a lot of investors. They help underwrite deals for them, but they're just absolutely head over heels about this product, because we think about a short-term rental. You may be receiving deposits daily or weekly, and those deposits can then go into this respective account and hopefully lower that balance at an even faster rate, creating greater cash flow. Equity position.
It's just math. The sooner money hits the account, hits the principal, the more benefit you get. You could take 2 customers who make the exact same amount each month and flow the exact same amount in total through the all-in-one loan monthly. But the individual who maybe gets it more routinely, right? Maybe weekly or even biweekly in terms of income receipt, will actually make faster progress on the product. That's the beauty of the interest recomputation on a daily basis, is it creates the savings advantage on a day. The benefit is daily, not monthly, not annually, it's daily. And it's a powerful tool.
Yeah. So, coupled with the fact that short-term rentals can cash flow more, you're cash flowing more and you are increasing the frequency of deposit. I mean, it can become an immense tool for that type of investor.
Absolutely. Well, no. And then we also think of, obviously, certainly we believe in the long-term hold, right? But to raise capital from time to time, you will need to flip a property, right? And so if you have this money sitting there going, okay, when that opportunity arises, we have this money sitting there. Well, if the money's just sitting there, put it in the all-in-one account, right? So that you can, benefit from that. And then as investors, we all are smart and wise to have reserve accounts, right? So we have reserve accounts for each one of our rentals. So if we have, say, $20,000 sitting there for each of the rentals, say we have 5 units, that's $100,000. The power of depositing $100,000 is just amazing when you look at the simulator and how it benefits you. So like from the investor side of this, you look at this and you're like, this is the greatest thing, I mean, it's just incredible.
Yeah, it's also a hedge if you think about it. It's also a hedge to inflation, right? Inflationary pressures are eroding away cash flow, right? And cash is king, but deployed cash turns into wisely used and money that will hopefully turn into a very valuable asset. And that, when you think about the impact that inflation is having on the average person, whether it's a real estate investor, just a regular homeowner with one home, with one mortgage, the reality is that, people commit to paying on their mortgage and their payment is maybe fixed. That feels good, but wouldn't you rather have a payment that reduces? That's the difference. It's the black and white choice. Have one that's static and won't move, which causes more and more pressure financially at the home, because your buying power is evaporating, right? As inflation continues to grip America. And would you rather have a hedge in place to where your mortgage expense is actually reducing, maybe at a faster pace than inflation has risen or will rise again in the future? That's the benefit, right? And regardless of how somebody is utilizing the mortgage or what type of borrower they are and what their goals are, I think that's also a huge advantage, is the realization that your mortgage expense on a monthly basis reduces automatically means that you are left with more money, right? Your own money that you've already earned, right? Available for bigger and better things than paying mortgage interest.
Yeah.
Absolutely.
Yeah.
Absolutely. Oh my gosh. Well, we cannot thank you enough, Dave.
Of course.
Like I said, your two presentations out here were so powerful, and they've opened so many doors. And, we're looking forward to, there's all this, doom and gloom on the news about, 2023 and what's coming up. And, we're excited because this product, again, is just such a great conversation starter. And it's a way to help people, like you said, we're here to serve people, help them, and get them in a better position. And there's no better product on the planet that can do that for people. So, we just want to say thank you so much. And we're grateful this time of year, and happy holidays and everything. And, we're going to get you out here at least a couple times next year so that you can, take your quick flight across the way and get here to sunny Scottsdale. So
yeah. Could be there in 45 minutes, you guys. So yeah, would love to. Thank you so much. Happy holidays to you guys as well. And I look forward to our future endeavors together.
Thanks so much, Dave.
You as well.